Hello and welcome everyone to another live stream of engineering and investment. I'm your host Austin, and today I have a loaded show for you guys. We're going to talk about a lot of stocks and a lot's happening in markets. We'll talk about some credit card companies. We'll talk about Palantir. They just had record-blowing earnings. We'll talk about an audience suggestion. We'll do some follow-ups on some stocks we've talked about in the past and see where they're at. There's been earnings have been going on in the market, and that means these fast graph charts will be getting updated as earnings come in. So with jumping right into it, I'm going to start with Construction Partners, ticker ROAD. ROAD. Now this was a suggestion from one of my viewers. This is a perfect point to shout out. If you guys have suggestions, leave them in the comments. I would love this to be a viewer-informed, viewer-led show with what we want to look at. So with that being said, we're on the summary page. We can jump into historical and take a look. As we see here, they have been around since about 2019, and their earnings have been mostly up and to the right. Their construction and engineering, as you can tell from the ticker ROAD, they do road construction and get government contracts to, orange barrel season all across America right now. I just got done driving to Maryland all through Virginia, and there's all kinds of construction. I'd be curious to know if some of that construction was done by road. So first initial impressions, we look at it. We got the black line, which is, again, the share price is hovering far and away above the orange line, which would be the theoretical fair value. So this fair value line comes from, it's either going to be at a 15 PE, and Fast Graphs uses a blended PE between trailing and forward looking. We could do the math to figure out just what blended means. I haven't put the time in to figure that out yet, but we could. So ROAD here, if the earnings growth rate, or whatever metric we're looking at, but it's earnings right now, is growing at greater than 15%, it'll replace this 15 multiple with whatever the growth rate is. Lower than a 15% growth rate, it just uses 15 here. So ROAD here, historically across this time frame, has had a 12.8% earnings growth rate from operations. And so if we plot the normal blue line, and normally trades at a much higher valuation, we can look at perhaps a different metric like operating free cash flow, and we see that it's typically traded at a lower multiple than a lower multiple for free cash flow than the orange line. So ROAD, they are $6.8 billion market cap, so a relatively small company. I have their investor page pulled up right here, and we can talk about company profile and what they do. So asphalt centered infrastructure company. They operate across 8 states, doing all kinds of roads. So let's check out their management team. Jewel Smith, dude's named Jewel, it's got to be a good one, right? He joined when his family business got acquired, and so we got Greg Hoffman. He hasn't been there. Well, he's been a part of them for a while. So anyway, we can look at their latest earnings presentation. So U.S. lane miles. That's an interesting metric that they're tracking. So I guess that means how much road there is has increased by 8%. And U.S. travelers are increasing their travel by 16%, and cars are getting heavier. So I think these are interesting metrics to track here. Let's see, structural demand. So CPI, so Construction Partners, operates in 6 of the 10 states with the highest population growth in the U.S. So we got, it looks like they operate in Texas, Florida. Oh, that's just the top 10. So that looks like they operate in Texas and Florida and Tennessee and North Carolina. My mouse is freezing a little bit here. Let's just continue looking at this beautiful graph, and maybe we can figure out which 6 of the 10 they operate in. Well, we can look and see that New York is losing. New York and California are losing population, whereas the highest growers, we got Texas, Florida, North Carolina, Georgia, Arizona, South Carolina, Tennessee, Washington, New Jersey, Utah. Most of these states stick out for a particular reason. 9 out of 10 share something in common. So the next mile marker. All right. So okay, here's our state footprint. So they operate in the South. So I'm sure I went over some roads that they were working on recently through Tennessee here. So this is we can go back to FAST Graphs now that everyone has a great idea of what this company does. If my computer doesn't, okay. Alright. You know, we gotta blow this show up so I can afford a new computer, because this is going swell. So if we look at this company projected on operating earnings, they're projected to grow earnings at about 12%, which they're trading at a much higher PE than 15. So if we got our trace back down to like a 15 PE, you'd be losing a lot of money on this company. If they kept trading at their 42 multiple that they're currently at, which then you're going to get the earnings growth rate that you currently see. So I would say this company has a decent amount of risk associated just because of how high a multiple that they're trading at. Basic earnings doesn't look that different. I was going to project operating free cash flow here as well. So they grew operating free cash flow a ton back in back in 2025 and 2026, and they're projected to grow it by 20%. So if you put that on the multiple, you could be growing your investment at 35% year over year. I would say this company probably deserves to trade at a multiple, a premium multiple, maybe not 42, but a premium, because government contracting and roads are not going away. The government's going to always be the biggest spender, and that trend doesn't look like it's reversing anytime soon. And they're very experienced in their field, and doing construction on roads seems like the boring type of business that is not going away. And they seem to have a foothold. Let's check out how well the analysts do, because we can't really know how well we can take those numbers without seeing the scorecard. So they usually beat or they miss. The analysts haven't really had a good grasp of what Road is going to be doing, at least in operating free cash flow. We could look at how they do at projecting earnings. And in this picture, we see it a little bit more balanced, and there's actually some green on the pie charts, but it's still kind of hit or miss. So these numbers, taken with a grain of salt, they're either going to be way beating expectations or they're going to be missing expectations. There's not really a meeting expectations here. This seems like the kind of company that I'd be interested in if the valuation came down a bit. I'd be really interested if the valuation came down to like a 20-25 PE, but from there we'd have to see a 50% haircut on the stock. So this is definitely going to be on my watch list. I'm very interested because I like boring government contractors. That's kind of my shtick a little bit, just in what I'm familiar with investing in. But right now it's a little rich. Just the valuation seems a little bit in the nosebleeds on this graph. If we see a pullback, this might be on my list. So Road, great company, I think, but the valuation just looks really high. Let's check out MasterCard. Now, who doesn't know what MasterCard is? They are the quintessential credit card company that most people have a credit card of theirs in their pocket somewhere. So this is the most beautiful type of graph you always love to see. So if we take off the price, the normal PE, and we just see the earnings, and it's just up and to the right, steady, steady, steady. That's the kind of chart you want to see. So if we put price back up there, we put normal multiple. MasterCard, they trade at a premium. They are one of the biggest companies in the space. They just make money hand over fist. Of course, they're going to trade at an elevated multiple. If we go to forecasting, so they're currently trading at a 30 PE, but they're growing at a 16% year-over-year rate. So if they manage to maintain their valuation, you could gain 16%, almost 17%, which is right in line with what I like to return. So MasterCard, I'm sure that they've been around forever. I'm sure they're really pretty easy to project with their spreadsheets, and so the analysts are dead on, so you can trust these numbers pretty good. Any dips, I'd scoop MasterCard up. Any chance I had, any dip they give, scoop MasterCard up. They are top tier company, just top tier. I would say this isn't going to be, this is how you make it to retirement with base hits and doubles, essentially. You know what you're going to get. This isn't going to be a home run. Like, you're not going to get, one day it's just going to double on you, because it's already a $500 billion company. But they're going to grow your money. This is one of the best companies out there. We'll look at their competitor, Visa. I would also like to say that about Visa and MasterCard both, they seem like the only investable, not the only investable, some of the best investments in the payment space. Like we talked about Block last week, and there's PayPal, and there's payment processors, and there's Toast, and there's Venmo, there's Cash App, there's all these companies that tried to process payments, and Visa and MasterCard pretty much undergird all of that. And so instead of trying to pick winners with payment processors and they're kind of on the race to the bottom, and there's a lot of competition. Visa and MasterCard are pretty much it. There's American Express too, but they're pretty much the only people in the credit card game. So we look at Visa's historic. Looks a lot like MasterCard, up and to the right. That's the prettiest graph you can have in stock trading. That's always what you're looking for. If we go back to forecasting, so Visa only has a 13.6% projected growth rate, but they're trading at a slightly lower valuation, like slightly. We're talking 30 PE to a 28 PE. Visa pays a little bit more of a dividend. We're talking about 0.74 versus 0.62, so it's not like a huge dividend. So if it maintains its current valuation, you're looking at about a 14.5% year over year. So MasterCard looks slightly better than Visa in this graph. I do have to say, it seems like most companies have passed on the charges that these companies charge to the vendors onto the customer, and you can tell because when businesses offer cash discounts, it's just it's a subtraction of what the Visas and MasterCards are charging them, because your 2% cash back or whatever rewards on your companies is just pretty much coming because they charge 3% to the businesses to use those cards. So really, you're still losing 1% on every transaction that you do because of the credit card companies. You're paying 1% for the convenience of using a credit card instead of using cash. So that's what the credit card companies do. They charge massive usury type interest rates when you miss payments, and the fiscally irresponsible. I mean, if anybody's seen the what's Caleb Hammer's YouTube channel called, Financial Audit, you see all those people. That's who Visa and MasterCard are making all their money from, are people that are financially irresponsible and can't get out of credit card debt. So when you're a shareholder, you want to watch Financial Audit and be like, yes, these are my customers, as I am the shareholder, and that's I know it's a little bit, it's kind of a predatory business model, but this is America, and that seems to be what makes money. So if you want to invest, they're not gonna get. I don't think they're at any legislative risk or anything like that. They've got a really powerful lobby. So, like I said, high quality companies, Visa and MasterCard, they're gonna be how you hit your singles and doubles on your way to retirement, long time horizon, 15% year over year. Any dips, buy the dip, is essentially. Now, this is not financial advice. Full disclosure, I own MasterCard. I've owned it for a very long time. MasterCard is a top tier company, but buy what fits your portfolio. The next one I want to talk about is Boston Scientific Corp, because this company, this one came across my list because one of my coworkers' fiancés works for this company, and they said they were going through a lot of layoffs, and she was worried about not having a job anymore. So, so you can see Boston Scientific, they're healthcare labs. I don't exactly know, but they run some tests and things like that when you get your blood drawn and stuff like that. They operate all across the country. So we see they had a huge run up, and this is why I bring up this chart. This is a perfect example of, you think, Boston Scientific, their earnings are up and to the right, right? You know, you look, it's up and to the right for the most part, except for COVID when everything's, you know, was not how you wanted it to be. Like, okay, this is up and to the right, the kind of graph you want. But then, bang, you put price over it, and the valuation gets way out of line with the fundamentals of the company, and you see this huge cratering back down. And where did it fall? Right back to the orange line. And this is why I like this tool so much, and why I always harp about regression of the mean. And if you're investing in a great company, there's still a lot of risk if the valuation is high, because value is combined of what you're getting and the price you pay for it. So this could be a solid company, but if you paid way up here for it, then you're paying way too much for it, and you've reverted way back to the mean, and you've lost a ton of money. So, and I mean, this was quick, like less than a year, and you're talking about, so it went from like 100 to, I mean, we're talking about more than half in less than a year. So that's why valuation matters. And this is one of the reverse scenarios. This is where the valuation gets way too high and it comes mean reverting back to the orange line. And we'll eventually look at a company where, I mean, it can do the opposite thing, where a company can get way undervalued and get a mean reversion back to this orange line. So let me go back to forecasting this company because I haven't looked at it. Now that they've cratered 50%, let's see if they've fallen into good buy territory. Because now they're touching the orange line. And this is also a good opportunity to say, just because a company has fallen into fair value doesn't mean it's a great investment yet. So they're growing their earnings at about a 7% per year. And they're right at fair value, which means you're going to grow your investment at, okay, 5% per year. That's, you know, that's wonderful. That's like buying government bonds. So, I mean, the analysts are really good at predicting what this company is going to do, so you can take all these numbers pretty much at pretty good face value here. And it's one of those, I mean, I'm looking for a little bit more return on this. This is than this. This is, so just because a company has fallen and cratered doesn't mean, and they've come back down to fair value, does not mean that it's a good investment at this point. This is a great case study in that. So I think with that being said, we're going to follow up with Palantir because they had some fabulous earnings, and their stock has absolutely skyrocketed. And we were just talking about Palantir about a month ago, and I was saying it was about $100, and I was saying this is a screaming buy. This company is fantastic. They're making money hand over fist. I think I'm going to buy some. And let's see. Okay. We go to the historical chart here. We see, okay, it was falling, and bang, really great earnings report, and it jumps up. Now they're trading at 136 times earnings, which is a crazy high valuation, but it's a crazy good company. So they've come back to the blue line. We can take a look at forecasting their earnings, and so they're projected to grow at 50% year over year. And so this is one of those companies where it's having fantastic earnings, but the valuation gives no room for slip-ups or bad news. So if it comes back down to even just a 48 PE, which is a huge PE nonetheless, that's huge, you could be losing money. But if it maintains this 136 PE, you could be looking at 50% year over year. Even from this point, this stock has ran like 30% in the past 2 days, you know, or past week, based on that earnings report, and you still could be making 50% year over year. They crush earnings over and over again. So I think this is one of those companies where I'm not gonna FOMO in. I'm gonna wait for some pullback, and I think I'm gonna start dollar cost averaging and buying dips, because any dips on this company, they seem to be a fantastic company. So they're growing free cash flow at the same rate they're growing earnings. I think that's pretty common for a software company, because there's not much that goes into capex or things of that nature. It's you get free cash flow, it goes to earnings essentially. So Palantir, fantastic earnings, fantastic company. They've shot up a huge amount over the past week. If we see right here, we were talking about it kind of in this dip over here at like 120, and I was saying, oh, this is a great company, I think I want to buy some, maybe some dip, and then I missed my chance and it just took off. So I'm going to wait. Hopefully, after this vertical move, I see a little bit of pullback and I can start dollar cost averaging, because this company is fantastic. Again, that's probably what I'm going to do. This is not financial advice. You do what makes sense for you. But fantastic company. I think a theme for this video should be fantastic companies with slight valuation risk. I would say Palantir has a higher valuation risk than Visa or MasterCard. Road had a valuation risk, but seemed like a fantastic company. And Boston Scientific Group was an example of a company that had valuation risk that cratered. So I think at this point I want to follow up with one of my bags I'm holding and show you my thesis of reversion to the mean in the reverse, the opposite direction that we saw with Boston Scientific Group. So we see the share price absolutely cratering well below this orange line. And so my thesis is reversion to the mean back to the orange line. That's pretty much as simple as it gets. This company is a cash cow. They get subscription money. There is, I think, in my mind, my hypothesis is, this is just my hypothesis, that the bottom is in now, because it was peak bad news. Subscriber loss of their broadband cable was, management on the last earnings says this is the worst of it. They actually paused the buybacks, and their buybacks weren't at as a low price as the share price went. And we finally got clarity on there's a merger happening between Charter and Cox Liberty, some other internet company. And so that merger should be happening, I think, August 19th. Someone on StockTwits, which, no one lies on the internet. So, of course, this person on StockTwits said they're an employee of the company getting acquired, and that they have internal email saying merger is going to happen on the 19th. Be ready. Do all your stuff to get ready. So it looks like it's happening. I think that was peak bad news, and ever since that's happened, we've seen a brief turnaround. So I think the reversion to the mean could be violent and upwards, and that's what I'm hoping for, a big short squeeze. So even at this point, it's gone up from the earnings low of $109 to $152. So you could have gained like 40% from the lows at this point, and it's still this undervalued. So if we just return to a 15 PE, and I mean they're growing earnings at 11%, then you could be looking at, this is according to this, in 2 years we're looking at a $750 stock. I'll put that on the screen. And you could be doubling your money year over year. So granted, and even if it only goes back to a 10 PE and it's a $500 stock, you're buying it for $150. So this is one of those, if you read Peter Lynch's book, One Up on Wall Street, this would be a turnaround story, one of his archetypes, and this is deep value investing. Speaking of value investing, Warren Buffett's Berkshire Hathaway, this is not related to Charter, but Berkshire Hathaway has been a net buyer of stocks in this past quarter, which they've been famous for sitting out this most recent run up and been in treasuries because they can't find anything of good value. That's their words, not mine. I think I'm paraphrasing, but um, that's some of the value investing. So that's Charter. I think I wanted to follow up. I think that's all the companies I wanted to follow up with at this point. I want to talk about. I talked about Kroger last week, and I want to talk about Kroger again because Kroger for the wins, as someone commented. It's still looking like a good buy, forecasting wise, 22%. So let's see, you can buy the credit card that you're going to buy the groceries with. You can buy the AI in Palantir that they're going to set individual based pricing with at the grocery store. That's coming. It's coming to a store near you is personal pricing based on AI. So they change the price depending on who's buying it. And then you could buy, and you're buying that with a credit card. So that's how and you're going to drive and go over the road. So that's the investment thesis for all these companies combined. And then you're going to go and have Charter cell phone service on your way as you're shopping. So there, tying it all together, nice with a nice little bow. At this point, I'll say like the video, tell your friends, leave suggestions. I'd love to cover stocks that people want to hear about and start a conversation in the comment section. Bring your deep value investing insights or some of your ideas, and we can pick them apart on the show. With all that being said, see you next time.